this morning? How's your weekend? Good to see you. Nice to have you. Hope everyone is great. You guys hear me all right? Volume's good. I'm a few minutes early. Nobody? Okay, thank you, Jeffrey Dean. Hey, good morning. Everybody's like, darn it, Mark, you're 3 minutes early. Good morning, Alex. Good to see you. Welcome to the room. It's going to be a good one. Great weekend, restful, sunshine. Gonna be a great week, guys. Gonna be an awesome week. Um, we'll give it a second. We'll let some people jump in here while we look at news. Every morning, checking news. Every morning, just looking for high impact, guys. Um, I've never. It's funny. I've never worried about what the news was. I never bothered to. Oops, I think I messed up my link. Maybe I didn't. Never bothered to go, wow, it's flash manufacturing PMI. And the flash manufacturing PMI could create a disturbance in the force that makes it go up or down. And guys, I don't worry about that. Every morning I come through and I look at my news and I'm looking for the red boxes. And if I see a high impact news, it's instant for me. It's, hey, okay, no more. I'm not going to trade into it. I'm not going to try to hold a position through it. All I'm going to do is sidestep, let the market do what the market does, and then when it becomes tradable again, I'll jump in and trade it. Hey, what's going on, Alpha? Good to have you back in the room. So at 9:45, Flash Manufacturing PMI, Flash Services PMI. If you are one of those people that needs to know, click on the box. Level of a diffusion index based on surveyed purchasing managers in the manufacturing industry. Whatever, right? It could create a bump, guys. It could create a jump. It could create a spike. It could make it too fast to move your stops and targets. So anytime I see high impact, I'm just like, all right, I'm done. Sit on my hands. I'm going to wait. So we check that every morning. That's part of the room every morning. We go through. Your job is to set a timer, put a note, something that says, hey, 9:45, high impact news. And you'll have to make your own decisions whether or not you want to trade into that. Everything that I talk about does come from the Nexgen page, guys. One thing that you'll find, there is, guys, give me a Y if you can hear me. Please and thank you. And remember, if you can't hear me, just say it in the room. There we go. Hey, what's going on, Cav? Also, that's not the right one. There's a place where you can look and see and make sure that you're not muted too. And I believe it's this one. It's all right, it's Monday. We'll slow roll, right? Do that too. Make sure you're not muted. So hopefully that works. Cav, it is a great day to trade. Great day to follow rules. I love that. I love that. Guys, everything from the trading guide, all the rules that I teach each and every day come from the trading guide. All the looks, what they mean, everything that you need to use this software successfully is going to be given to you in the first hour of this classroom. And I say everything that you need to use the software successfully, and I'm very deliberate about that language because I'm not going to give you everything you can do with the software, guys. Everybody uses this software differently. They all start at the same place, and then they tend to grow into plans that make sense to them based on how they're reading their indicators. So what I do each and every morning, and pardon the scroll, guys, I know that's a little aggressive, is we're going to spend probably about 45 minutes talking about what we call a high probability trade, specifically a high probability trend trade. This high probability trend trade is a trade when each indicator on every chart agrees with the rules for the trade. Triggers will be their strongest, no termination conditions should exist, and there's no trouble between you and your target. This high probability trade is a trade that typically wins 70 to 80% of the time when you follow the rules. The high probability trade is a trade that creates an awful lot of confidence through that memory of success. One of my favorite phrases, the memory of success creates confidence, and it's true. And the more confident you are in your plan, the more likely you are to stick to your plan, to follow your rules. But the most important thing about this high probability trend trading, guys, this is for the new users, is it's going to teach you to read your indicators. The high probability trade is the trade, whoops, I thought that I had started my slideshow. I had not. There we go. It's just a trade that's going to teach you to read your charts. That's the whole goal of the first hour. And I think that it's almost a little disappointing to some people. My goal in the morning isn't to teach you everything that you could ever do with the software. My gosh, we would be here for decades. But if you focus on this highest probability trend trade, if you learn these rules, if you understand the advantages they provide, you're putting yourself in a position, you're becoming a chart reader. And what you will find is that about 90% of your day is just reading charts. There's an awful lot of sitting still and doing nothing when you are a successful day trader. There tends to be a lot more action in the market when you're a struggling day trader. I sat in front of the charts for 3 hours today. I activated limit orders 3 times. 3 times my limit orders weren't hit, guys. No trades for me this morning because I'm so confident in my plan, because I've studied my plan, I've practiced my plan, I've proven my plan, that I refuse to enter the market if my rules aren't met. And my hope is that you guys get to that same position, because rules are a pattern. That's all they are. They are a description of a pattern, and the pattern has to be proven to win more than it loses. That's what the high probability trend trade is. And once you get this foundation, once you can read your indicators, you're going to understand 3 real key concepts. The first one is that you will be able to recognize, pinpoint, and use where the market is likely to continue. This will become your entry for your trend trades. You're going to understand where the market is likely to go over time using momentum indicators, using key Fibonacci areas. And this is going to help you as you develop and grow your management plan, knowing where exits are appropriate. And then finally, and I think most importantly, you'll have a very clear understanding of where the market is likely to stop. And we call these termination conditions. And once you can say, all right, this is the direction the market's going, and it's got all my advantages, let me get in where it's likely to continue and try to ride that wave all the way until it gets to where it's likely to go. As that's what the high probability trend trade does for you. So we're going to take an hour to learn to become chart readers, and then from becoming chart readers, eventually turn into day traders. So the high probability trend trade is only 3 rules. And one of my favorite phone calls in my time with Nexgen was a gentleman that told me that there's no way a trade with 3 rules could be an effective trading plan. And guys, I want you to come at me with that skepticism, because what you'll find is that 3 rules is plenty. And each rule, when true, creates an advantage. And if you learn to begin to speak to yourself, not I hope the market goes up or I think it may, and you say, okay, I have momentum, my path is clear, let me define an entry area. That's the recipe for a trade, guys. It's advantages. And when you begin to look at your charts and you only see them as either advantages or disadvantages, it helps you choose to enter. It helps you understand when you have to manage a little more assertively. And these first two advantages, momentum and clear path, this is your foundation, guys. Once you can recognize these two, and you'll get to the point to where it takes you about 2 seconds to recognize momentum and path. This is enough to build a very consistent trading plan. This is enough to find opportunities outside of that high probability trend trade. The entry area, rule number 3, that's specific to trend trades. So we're laying this foundation right now, guys. 3 rules, and we're going to let them happen on 2 charts. That's it. There are more charts. There's more ways. We're going to use a large chart and a small chart. That's all you need for the high probability trend trade. Even better, you need the first bar on the large chart. You don't have to look at 8 hours worth of data and draw trend lines and look for patterns. In the first bar on the large chart, you will be able to define direction, momentum, and areas. It's a very broad stroke of a brush. It's a very slow moving chart. It shows the overall opinion of the market. Rule number 1, the advantage of momentum will be recognized using only the first bar on the large chart and the trigger lines with it. Understanding whether or not you have a clear path will be defined right here at the beginning rather than behind. And once those 2 rules are in place, momentum and path, that's when you'll turn your attention to a smaller, faster chart. Rule number 3 is a little recipe designed to pinpoint precisely where the market is most likely to continue with the trend and the momentum and the path established by the large chart. This is your refinement chart. It shows the inner workings of that 1 bar. Typically 15 to 30 bars on a smaller, faster chart. But by using this refinement chart, you're going to be able to pinpoint, you're going to be able to reduce risk. You will be able to maximize your profit potential. So rule number 3 for entry is only addressed when rules 1 and 2 are in play on the large chart for the brand new user. We use the 2 charts because it really is. It's a reflection. It's a statement about who you're trading with or who you're trading against. The large chart, the big chart, that's the large crowd. And these guys have the money, the influence, the power. They create trends and they establish momentum and they react at key areas. And you know that the large crowd typically wins. So the highest chance of success simply comes with following the large chart. The small crowd, these are your fighters. These are the people that can create retracements and little pushbacks and fights that are counter to everything that the large crowd wants. And we appreciate the small crowd because it's their fight that is going to get you to your great entry. It is their push down when everything says up. You're going to pinpoint where they're most likely to fail. And they fail typically 70 to 80% of the time when the rules for the high probability trend trades are true. When you say are your trigger parameters, help me out, Lonnie. What do you mean by trigger parameter? I'm looking at your ES chart. It looks like we have the same picture a couple times in there. When you say trigger parameters, I'm going through your pictures here. Your ES, well, your ES and your RTY, they're different markets, right? But your RTY, sorry guys, little digression here because I always want to make sure if you think you have a technical issue. You have small triggers, you have large triggers, you have odds favorable momentum. This is the RTY. You've got a pullback directly to support inside of favorable large triggers. Everything looks normal on this chart on the RTY. On your S&P chart, let's take a look. You've got small triggers and large triggers. You've got areas inside. What seems different? They both look normal to me. Remember, RTY is $5 a tick. ES is whoops, sorry, $12.50. So the money's not going to be the same, Lonnie, but everything looks like it is. And remember, you can't have a 50-50 trade without odds favorable momentum. And if price reaches resistance, it's actually directly into a termination condition. And that's the kind of feedback we're going to do in the second hour. So we'll come through and look at those. Yeah, but it seems right to me, Lonnie. And guys, always ask. If you have a concern, always ask. We'll take a look and make sure. So guys, large chart, small chart, overall opinion, little refinement. Following the big chart typically is the path of least resistance. Good morning, Morgan. So this is what we're going to do this morning. And do I have new people in here? I see new names in here. Key holder, that's a new name for me. Kelly, that's a new name for me. Who else is new in here, guys? Doug B, are you new with me in here? Maybe not. No, Doug B is not. That's an old name. Guys, if you're new with me in here, I'm going to tell you right now, I do the same thing every day. I talk about the same stuff every day. We look at the same stuff every day. On your 1 week trial, awesome, key holder. So this little thing that I'm going through, Black Prince, you're still new. I like it. I'm still new, Black Prince, 5.5 years in. I learn something every day. So key holder, let me tell you how the classroom works. You're going to love this. We're going to spend the first hour or so, and all we're going to do is we're going to take one trade, and we're going to break down each rule individually, and I'm going to give you exactly what it looks like. I'm going to tell you exactly how to identify it. I'm going to give you tools to study and in a place where you can put all your study materials. And the goal for the first hour is to just learn the trigger line and the Fibonacci rules for when it's okay to trade. And what that means is that as a brand new user, one of the best options you can give yourself as you learn to read these indicators is if the rules are met, I'll take a trade. If the rules aren't met, I choose to not take a trade. And that's really a pretty simple approach. And that's what separates the successful from the struggling typically, is a willingness to do nothing when the advantages aren't present. On your trial, you have a working set of software. You've got a platform to run it on. You've got everything you need to simulate and to practice. You do have Capture software. It's downloaded on your computer when you get the software loaded on. And the TechSmith Capture software, and I'm bringing mine up right here, this is how we communicate in the room. So you can type a question in, absolutely. But if you use this Capture software, if you click that big red button, and you can just click and drag and it'll take a picture of whatever's on your screen, hit that camera, you've got this call out button on here. And let me make that big so it's not confusing. And it puts a big text box. And this is where we talk. This is where you tell me what you see. This is where you tell me why you did what you did. This is where you take the time to show me how you read your indicators, because the whole goal of my classroom is to teach you to read these indicators. So if I know what you saw and there's a challenge, we can correct it. We can work around any challenges. If you show me your entries all the way to exits, we can have lessons on management. You can have lessons on chart reads. So just take that, copy it, drop it in the room, and start that conversation with me. Don't let this be a lecture. So simulate, practice, mess things up. It's cool because we're all brand new here. But keep posting in the room. Everything you see, everything you do, post in the room. And it's like getting a private session with me. As we get into the second half of class, that is where I'm going to click on your pictures. And this is Pete's. And Pete says, Mark, this is what I saw. This is what it looked like. This is where I got in. This is where I got out. That's why I did it. Mark, do you see anything that I might have missed? Did I read the momentum strong? Absolutely you did, Pete. Did I recognize the path correctly? Well, you did, because it has potential to break. Waited for a full bar to clear trouble, got in with momentum. Absolutely beautiful. Pete, this is such a great looking trade. So what we're going to do is Pete's going to get that feedback. Pete's going to go, wow, Mark said this is great. I had all these advantages. The management made sense. Let me put that into my spreadsheet. And that's the second thing that's going to get you to where you want to be. First, post in the room. Give me a chance to talk to you. Tell me what you need help with. The second thing is the spreadsheet. So Pete's going to go to his trade tracking sheet, and he's going to drop that picture into his sheet, and he's going to say, I had my advantages. And over in the feedback section, he's going to say, Mark said, don't miss this perfect look. And what he's going to be able to do is he's going to be able to go back to all the trades that he took today. And he's going to be able to ask himself what worked and what didn't work, and what was the feedback, and what felt easy and what felt forced. So tomorrow morning, after that little 2 to 3 minute study, he's going to be focused on embracing advantages. He's going to be focused on repeating successes, and he's going to be focused on avoiding challenges. And this is how you're going to accelerate the learning, and this is how you're going to get a little better each and every day. So we're going to learn the rules, and you guys can simulate and practice and post them in the room, and we're going to simplify heavily. And that's what I try to do for new users, because I understand completely. Let me show you my picture key holder. This is going to be your first day, and it's going to be like, whoa, that's a lot coming at me on a first day, and it's going to feel that way. But the way I teach this room is it's designed to break down one trade into its most basic form, to focus on learning a couple advantages, to learn how to read those advantages before you try to become a day trader. So I'm going to hand you guys a plan today, and I'm going to give you a plan with only 2 trades on it, and your job is to learn the looks. What does it look like when my rules are met? Because my rules describe a pattern. My rules are just a description of things happening, and those things, when pieced together, have been proven to win more than they lose. And that's where the spreadsheet's going to come in as well. The spreadsheet, the first tab. So if you're one of my brand new users, I'm going to drop my spreadsheet in the room for you guys right now. There's a basic rules tab. In this basic rules tab is strong triggers, which is rule number 1. And I've put, oh my gosh, a little over 50 pictures of what it means to have strong triggers. And not only did I put a picture of strong triggers, but I described exactly what it means to have that rule met. So what you can do as a brand new user is you can go, okay, this is rule number 1. It always looks like this. This is the description. And now I know what it means to have rule number 1, and I know what it means to me. And then the red section is what it looks like when that advantage is gone, when it's time to maybe pause and not hope that the market does something without advantages. We've also got the clear path and termination conditions. So that first tab is going to help you get that recognition of the first 2, the first solid rules. There is a client trade section, and this is clients doing great things with the software, to be honest with you. This is over 400 pictures of you guys using momentum, using path, taking entries, managing. And I stole them from the room because I want to use Nexgen user pictures as a study guide for up-and-coming Nexgen people. Because it's one thing to hear me say that, yes, this methodology works. It's another thing to watch people using this software each and every day and finding success. So I want you to pay attention. You'll know that it works. You're just going to learn how to work it for you. There's the entry sequences for long and short, high probability trend trades, the management plan that you're going to find on the plan that I give you, other opportunities for management, and then patterns that repeat themselves. And that's what happens. Once you start reading your charts, you start seeing more, and you start adjusting your plan, and you make a plan that's very comfortable for you. And that's what this one is. This is building your plan. It just gives you a place to put your pictures. So you drop a picture in the room and the feedback is, man, this is perfect, never miss it. Drop it in your trade plan. And maybe you put a picture in the room and I say, do you see how this reached Fibonacci resistance? That would have been an excellent exit instead of giving 4 points back, and you'll be like, oh my gosh, what a great management tool. Let me drop that in the management section. And then the patterns you begin to see, take pictures, drop them in the room, let's discuss them. And this is how the classroom works. It's a whole hour of basics. It's remedial. It's 101. It's introducing you to what we're doing. And then the second half of class is nothing but feedback, live feedback. I'm here 15 hours every week with the sole purpose of helping you read your indicators better giving you any and every bit of feedback that I can provide in my 5 years of reading these indicators. So we're going to move forward and we're going to look at the high probability trend trade. But before we do that, let's just name some things. These are the indicators that you're going to see on your chart. Both charts will have small triggers and large triggers. And all you need to know is that 2 solid lines make up your small triggers. 2 dashed lines make up your large triggers. I promise you that's all you need to know. If you are an engineer, these are a fast-moving average, the small triggers are, and these are a slower-moving average. Not really important. But what's important is that you're going to use these trigger lines, and they're going to define the momentum that you see on a chart. You're going to use these trigger lines to define those termination conditions, those areas that could stop the market, and you're going to use these trigger lines to define your entries. So it's imperative that you know small and large, small and large. When they're up, they're green. When they're down, they're red. And then both charts will have areas. And depending on the charts, the areas may have a different role, but you really just need to be able to name them. So we've given them all names. Anytime you see a negative number and a magenta line print off a pivot, all it means is that the sellers stole the momentum from the buyers. There's a loss of momentum right at that pivot, and you'll see a magenta line print. You'll see a cyan line print if it happens from a low. You're going to see Fibonacci resistance, which is a red Fibonacci line. Fibonacci support is the blue line. And you're going to see these yellow 1-to-1s. These print real time during the day. These are kind of fibs in the moment. They're 100% Fibonacci alternates. And they'll happen. Your software will actually do measurements and project. So if the market is going up, these will behave as resistance. And if the market's going down, they can behave as support. So understanding just what they're called. On the large chart, we'll use these for termination conditions. On the small chart, we'll use these for entries. And now we're just going to break it down, guys. 3 rules. We're going to go through each. We're going to talk about how to identify them. And we're going to talk about the advantage and what it means to you. So large chart always leads the way. That big, broad stroke of a brush, that large crowd is going to lead the way. And the large chart must have strong trigger lines because it creates the advantage of momentum. And the only way to have strong trigger lines is if you choose to trade with the trend. So if the background's green on the large chart, the market's going up. If it's red, it's going down. And your job is to look for rules to be met going in the direction of the trend. And you can only have rules met in the direction of the trend because if the trend is up, the only way to have strong trigger lines is if both small and large triggers are green. And if the trend is down, the only way to have strong trigger lines is if both large and small are red. So everything's red, everything's green. At least I know that I can have strong triggers. And what strong trigger lines means is that your small triggers in an uptrend are up and above the large triggers. Large triggers must be widening. The small triggers create space between the two. Or in a downtrend, the smalls are below the large are wide, and there is space between the two. And I'm going to draw a picture here for my new users. I want you to picture scissors that are open, and that's the easiest way to identify strong triggers. The separation between the small and large, those open scissors, this is exactly what strong triggers are. And strong triggers give me a situation where the odds are favorable for the market to continue in the direction of the trend. The odds are favorable for the market to continue up. The odds are favorable for the market to continue down. So in this room, you're going to see that annotated on charts a lot. You're going to see OFM written on charts all day long. Odds favorable momentum. And that advantage of momentum, that first advantage, can push a market in the direction of the trend. That first advantage is what it takes to break key Fibonacci areas. That first advantage is even going to cover up some of the mistakes that a new user might make. And we're going to look to buy Fibonacci support on a small chart with odds favorable momentum up, and we're going to look to sell Fibonacci resistance on a smaller, faster chart with odds favorable momentum down. Momentum is probably the easiest lesson. There it is live in the crude oil. See the separation, see the push. That momentum is an amazing advantage. And that's it right there. Strong triggers up, strong triggers down. Can you guys give me a why if you're with me? And guys, I ask for the why, not because I have low self-esteem, but because I want to make sure that that very basic concept makes sense to you. Because this is the beginning to everything. Well, scissors close, guys, momentum goes away. So if separation is strength, hey, good morning, Doug B. If separation is strength, if this is odds favorable momentum, when your scissors close, when the small triggers work their way inside of the large triggers, guys, this is what we call a weakening of the large triggers. And when I have weak large triggers, anything can happen up or down. And key holder and alpha, you guys will both realize that I'm a big fan of language. When I see strong triggers, the thing that goes off in my head is odds favorable momentum. And when I see weak triggers, the thing that goes off instantly is anything can happen. Advantage gone. I don't feel good about risking my money with this look. Guys, anything can happen triggers are where retracements, deeper retracements happen, maybe sometimes from the middle of nowhere. Anything can happen triggers. That's when key Fibonacci areas tend to hold. And you'll see right here, there's that weakness. And sure enough, that was the beginning of the push down. So kind of cool, right? Strong turns to weak. With weak, right at a key Fibonacci area, the market reverses, and from that reversal, strength is produced again. So it's very black and white. You either have strength or you have weakness. Strong, weak. And guys, that's it. That's the whole lesson for rule number 1. And let me say something real quick. Strong triggers has nothing to do with price bars. Strong triggers has nothing to do with Fibonacci areas. The only thing you need to be able to recognize for strength, ladies and gentlemen, is a separation between the small and large. That's it. And then once you have strong triggers, you have momentum. And guys, this is rule number 1 for a reason. It's hard to stop a large chart with odds favorable momentum, but there's places that can. We call those termination conditions. And rule number 2 says make sure that they're false. Make sure that there's nothing in the way that could stop the market. Make sure that you have room to your profit targets. We're just going to call it a clear path. Because when I've got odds favorable momentum and a clear path, that market is difficult to stop. So what's a termination condition? This is from the user guide. A termination condition, is a Fibonacci-based indicator. Those are those areas that we talked about. Those horizontal lines on a large chart, guys. And it may reverse the market. Notice that may is not will or absolute or without a doubt. It may reverse the market. And we're going to compare the area, support, resistance, 1-to-1s, divergence, highs and lows. And we're going to compare it to the trigger lines. And I want you guys to remember, and this is probably one of my favorite lessons, is these areas on a large chart, these horizontal lines on a large chart. And I'm going to give you my PowerPoint, but there's the picture if you're a collector. These are where the large crowd makes decisions. These are where the men and women that move the market are most likely to enter, exit, fight, create reversals. So I want you to start saying decisions are made at key areas on the large chart. So to identify a termination condition, we're going to embrace that concept that decisions are made at key areas. And you have to let price reach your key area. Price reaches resistance, and resistance can be a magenta divergence high line. It can be red Fibonacci resistance. It can be yellow 1-to-1s. So once price reaches that area, we're done with price. Price is no longer a factor. All you have to do is ask yourself, where are my triggers? So price reaches, where are my triggers? And if your trigger lines, small and large, remain below that area of resistance, this area of resistance has 4 options every time price reaches it. It could create a big untradeable bounce. It could create a fight, an indecision between the buyers and sellers that you don't want to be a part of. It could break, or it could reverse the market completely. There is always 4 options every time price reaches an area of resistance and the triggers are below. You have to accept that you don't know what the reaction's going to be. You'll never know what the reaction's going to be. So if price reaches resistance, my triggers remain below, it's a termination condition, and rule number 2 is not met. And if rule number 2 is not met, that means absolutely, positively no trades into the area. Price reaches Fibonacci support. All you're doing is saying, hey, where are my triggers? And if your triggers remain above Fibonacci support, there could be an untradeable bounce. There could be a fight. There could be a reversal. There could be a break. I don't have any idea what it's going to be, so I'm going to sit on my hands and do nothing. Is everybody good with that? Let's go look at crude oil again. Price reaches resistance. The triggers don't break, and there's a reversal. Price reaches the support down here. The triggers don't break, and it bounces up. Straight from support, right off a divergence high. Straight from support. Guys, I'm not making this up. I'm scrolling back. Look at support, hold. Look at support, hold. Look at rule number 2. No shorts, no longs, no shorts, keeping you out of trouble, and then eventually that thing heads up. So, is everybody good? Give me a why. Price reaches an area, no triggers get through that area. Let's sit on our hands and wait for the reaction. And man, if that termination condition reverses the market, if that termination condition makes those large triggers go from green to red or red to green, we're going to call this a strong top. And you're going to hear that in the room a lot. Strong top, strong bottom. And guys, a strong top or bottom is the precursor to the highest probability trend trade you could ever take. A strong top or bottom is rule number 1 for the second trade that I'm going to give you in your plan. So understand that when decisions are made at these key areas, and they are so impactful that the market reverses, guys, you should have all the warm fuzzies in the world looking for the next trade. One of the options that I talked about was the market could break. It could go through that area. This is what it looks like. The first, number 1, with the big stop sign, is price reaches Fibonacci resistance. We're done with price. We don't need it anymore. The triggers tell the story. All of my triggers are below resistance. Therefore, this is a termination condition. My highest chance of success as a day trader is going to come from doing absolutely nothing because I have to wait for the reaction. Well, if they, and when I say they, I mean the large crowd. If the large crowd's going to continue up, both your small triggers and your large triggers, guys, they're going to get north of resistance. They're all going to get above resistance. Resistance is going to behave as support. And this is what it looks like when you have a clear path. All of your triggers have cleared the previous area, and we haven't reached a new area, guys. When you've got momentum and a clear path, you're going to go to that small chart and look for an entry. And then the transition from termination to clear path, guys. This is number 2. This is what we call a 50-50 look. And it's called a 50-50 look because 50% of your triggers have gotten north of resistance, gotten above resistance, the small. But 50% of your triggers, the large, well, they've remained below. So you know that it's not a clear path because it takes both triggers above to create a clear path. So this 50-50 look, if and only if you have that separation between the small and large, if you have that odds favorable momentum, guys, this look lets you know that that Fibonacci area has the potential to break, but it's not broken. So because it's only potential, you can still find trades. You can still capitalize on this look. And to be honest with you, the majority of your trades are going to be this 50-50 look eventually. You just have to manage assertively because it's not perfect. And this is where those strong bottoms come into play. Fibonacci support, no triggers break, there's your reversal. This look is what's going to set you up for higher success with this look. So first it's a termination. Every line's going to be a termination condition, guys, even if it's for a fraction of a second. Then it's going to give you the potential, and eventually it may break. Smalls and large below, support becomes resistance. And here's the deal, is your path is clear until you reach the next line. And then it starts over. And sometimes those lines are going to be real tight, one on top of the other, which means There will be times when your path isn't clear because the areas are stacked. So Alpha, Keyholder, Lonnie, Black Prince, Kelly, Muser, all you guys. This is 90% of your day. 90% of your day is saying, damn it, I don't have my rules met. I have to sit on my hands. Some of you might say, dang it. Some of you might say, dag nabbit. I don't know. Swear in your own way, guys. But this is 90% of your day, and it's okay to do nothing. Write it down. It's okay to do nothing. It's okay to not be in the market every time the market moves. The futures markets trade, I think the thing was $220 billion an hour. Trillions daily is exchanged in the futures market. Guys, we're going to take a high probability pattern. You're going to be able to use momentum and clear path and find a way. You're going to see the potential for an easy $400 to $500 a day. $400 a day puts you in a six-figure income with your day trading, guys. You don't have to be in every move. You don't have to be the first one in at a high. You don't have to be the last one out at a low. Hey, good morning, Joel. Good to see you, man. All you need to do is find the best of the best, because that's where the money happens. Termination, that one had the potential to break, but it didn't. The market pushed down, big untradeable bounce. That divergence high had the potential to break, but it didn't. So guys, you're going to see this a lot. Odds favorable, momentum tends to break. So that's your large chart termination, guys. There's one more that I do want to talk about, and this kind of sets us up for going to look for entries as well. Because the large chart is a slow moving chart, I want you to see the box around the one bar. This bar says odds favorable momentum, and this one bar says potential to break. On your smaller, faster chart, all of this happens inside of that one bar. So the small chart will show some change that you can't see coming on that large chart. And the small chart, if it gives you three divergences, three cyan lines from a low, three magenta lines from a high, this is the small chart telling you that change is coming. This is your heads up. And three divergences in the same price range may terminate the trend. It's the same is true on a large chart. Three divergences in the same price range may terminate the trend. But on a large chart, it might take you 2 hours to produce. On a small chart, it might take you 3 minutes to produce. So this is the only time on a small chart I will refuse to enter the market if I have momentum and if I have a clear path. Doug B, show me a picture of your 13-2, please. As I'm not even sure, what market are you talking about? Let's do this. So you don't know how. Guys, this is one of the most important things for my classroom. So Doug, we're going to do two things. First, I'm going to give you a fish, but I'm also going to teach you to fish. Here's your screen capture programs and your how-to. But I'm going to do a how-to right now, guys. We're going to stop before we go to entries, because this is like the most important thing that we can do in this classroom is have a conversation. So Doug, I want you to go to your search bar and I want you to type in tech. And you should see TechSmith Capture. Will you let me know if you have that in there, please? If you don't, I'm going to give you the link. Sorry, I know you just want fibs, right? And guys, this is for everybody. Open this up. Okay, so you don't see it. So here's what we're going to do. I'm going to give you this link. And if you would do me a favor, if you guys will please download it. It takes maybe 2 minutes start to finish to get this on your computer. This is how we're going to have a conversation, ladies and gentlemen. This is how you and I are going to talk to one another. You're going to show me everything that you see. I'm going to tell you everything I know about it. Sniper as a program comes with Windows, right on, Keyholder. Is there a way with Sniper, though, Keyholder, to take that picture and drop it into a chat box? Because what you may need to do with Sniper, and I'm not sure, I'm not familiar with it. So one of the things that TechSmith does for us with that capture program, when I take the picture, I can hit this upload link. And what it does is it gives me this app screencast. It drops my picture into the cloud, and I can drop that cloud picture into the room. And that cloud picture is the same picture that I'm going to come drop into my spreadsheet so that I have that active link to come back and see it. That's why we use this one. It's free. Personally, I use Snagit, which is the bells and whistles version of Capture. So, Doug, before you do that, and before I lose you here, when you say you have no blue fibs, what market are we talking about, Doug? Okay, so first thing I would check is squeeze a little bit. And you don't have any blue fibs anywhere? I'm going to give you the easy fix first, and we'll see if we get it done. Are you in the 525 contract? Or are you still 425? You can put a 5 or a 4 in the room for me. Because the April contract has expired, and if you haven't done this in a while, didn't roll over, you might need to roll your contracts. That would be the first thing that I look for. I'm not the tech guy, but I can usually solve most issues that are basic NinjaTrader. We on the right contract, Doug? The second thing I do is I click this F and make sure that my data... No, it's okay, Doug. Which contract? That's probably it if it hasn't been a while. Or if it's been a while. You just need to be in that 525. And I'm not stopping class for you. I'm stopping it with you. We're going to figure this out. That's what the classroom's for, guys. I mean, we do chart reading, but yeah, we make sure you're moving forward when you need to move forward. Doug, will you give me a Y or an N on the 525? Better, Dad. Okay, so click on it. I bet that's it. And get your little cursor behind the 5. Hit delete so it's 0-25 and put that 5 in there. So you want this up here, and you can just type it in. You want that to say 525. I had an S&P chart that came up this morning that was still in March, and I was like, man, my chart's not moving, nothing's generating. So I'm familiar with this one this morning. I had to do the exact same thing. I had to change it. If you do that and it fixes it, outstanding. If it doesn't fix it, right click on your chart and go to templates and load and get that 13.2 Rinko. And what that'll do is that'll reload the template and hopefully put everything back together. Those are going to be the two that are the most common. And then, of course, if for some reason neither of those gets you where you need to be, Doug, there's the link to my buddy Jason, and he will get you 32 flavors of Squared Away. So let me know if those work for you. And if they don't, let's get in with Tech real quick. He'll knock it out so fast it'll make your head spin. Awesome. All right, guys, large chart has momentum. Rule number one is met. We're looking to trade with the trend. The odds are favorable for the market to continue in the direction of that trend. Rule number two is true. There's no termination conditions. No area is likely to stop the market. So let's go define our entry, guys. And this is where the precision comes in. This is where we put the pattern together, if you will. So your entry is really so specific that you're going to use a limit order. You will develop the courage with a little bit of study to place a limit order and have the market come to you. And you're going to buy or sell a pullback. And when I say pullback, just so that the definition is clear, a pullback is that little fight from the small crowd. Everything here says up. Everything here says strong. Everything here says clear. That pullback is that little bit of down on a smaller, faster chart that the small crowd produces. And we're going to buy or sell that pullback, but we're going to do it at areas. So areas on a small chart, fibs, mid-bands, yellow 1-to-1s, can create a bounce to continue with the overall trend, with all that momentum, with the clear path. The same way on a large chart, those areas can create a bounce against the trend, stop the trend. We're going to use them on a small chart to create that continuation. And the key to the entry rules is that your areas are inside of triggers. Because there's this truth that happens is price typically returns to large triggers. So on a large chart or a small chart, price tends to break away from large triggers and return. And it breaks away from large triggers and returns. And you see this all day long. Breaks away and returns and breaks away and returns. So we're going to use the large triggers on the small chart. And we're going to put the large triggers from the small chart, the 5-1, and the large triggers from the large chart, the 13-2. We call these synthetic because they're from a different time frame. But on your small chart, you'll see both. And these trigger lines, these large trigger lines, will help you determine where the retracement is most likely to go. That's it. Price typically returns to large triggers. I don't know if it'll be the 5-1 large triggers or the 13-2 large triggers. So this big white box defines where the retracement is most likely to go. Is everybody good with that? Price returns to large triggers. This is a very identifiable pattern that repeats all the time. To have the lowest amount of risk, guys, to have the most accuracy, the smallest window of opportunity where the market is most likely to continue, you have the ability to insist on what we call favorable large triggers. And favorable large triggers mean that those large and synthetic are overlapping. They're one on top of the other. It's like two snakes riding piggyback, because that is the least amount of real estate where that retracement is most likely to go. And then when you put a fib or a mid-band or a yellow 1-to-1 inside, you've got the tiniest little window where the small crowd is most likely to fail, where the market is most likely to bounce and continue with the trend. So when we're saying our entry rules, I'm going to use a limit order to buy or sell a pullback at an area inside of triggers. So what that looks like, in this particular instance, the large crowd, the large chart, is absolutely screaming to the upside. The large chart is going to have odds favorable momentum. The large chart is going to have a clear path, and hopefully the large chart's even coming from a strong bottom. So when all of that's in place, my small chart is screaming up. It's flying, probably has odds favorable momentum, and that fear of missing out begins to kick in on new users. They're like, oh my goodness, it is screaming up and I'm not in it and I'm never going to get paid and I hate Mark Novak. Guys, we're going to wait for the small crowd to fight, and they do. This is one of the patterns. The small crowd creates fluctuations all day long. And you'll know that their fight has begun because you'll see a reversal bar. And a reversal bar is just a down bar after all those up bars. It's not your entry, guys. This is the beginning of the fight. So when you see the reversal bar, even when you get a little comfortable, you'll begin to anticipate the reversal bar. But you're going to look for those triggers, both sets of large and synthetic, because they're going to define where the retracement is most likely to go, where that market's most likely to retrace. And it's somewhere from the top line to the bottom line. So the tighter they are one on top of each other, the smaller this box becomes. But trigger lines are not your entry. Trigger lines aren't bouncy. They're like clouds. Almost work time for you? All right, give me a minute, Lonnie, and then I'll get you. Areas inside of triggers. This is what creates the bounce. This is where the small crowd is most likely to fail, guys. So we go reversal bar, identify the triggers, identify areas inside of triggers. This is where your trade is most likely to originate. So you're going to activate a limit order 2 ticks above that area. And you're going to say, come on, small crowd, come get me, because you've done all you can do. You've had momentum. You have the path. You've defined your entry. You've activated your limit order. And guys, if they get to you, if they make it to you, you are in a trade with momentum, with a path from the entry area. And this is a trade that typically wins 70 to 80% of the time when you follow the rules. So we're going to put Lonnie, we're going to put you on the block here. We're going to test your chart reads. And Lonnie's done a great job of telling me exactly what he sees and what he's doing. And guys, this is what the second half of class is going to be, but Lonnie needs to go to work, so we're going to make sure Lonnie gets his feedback before he goes. If you ever have to leave early, let me know. Strong trigger lines, look at that. Smalls above the large are wide, the space between, that's the best of the best look. Lonnie says, Mark, check it out, I have a clear path. And I'm going to say, Lonnie, I respectfully disagree, because your large triggers are still below the divergence high. Your small triggers have absolutely smashed through. And what you have here, Lonnie, is the potential to break that divergence high. And the only thing that means, Lonnie, is that you're going to put your management hat on. You're going to say, okay, I'll still take a pullback directly to support inside of triggers, but if something changes on my way to my targets, I might have to manage a little more assertively because it's not broken yet. Does that make sense? And then Lonnie, coming from the strong bottom, increases the likelihood of success here. And this is a beautiful trade. This is the entry that we just talked about. So alpha, key holder, do you see that? He is 2 ticks above support inside of the retracement zone. And Lonnie made $300 in about a minute and a half. And this is the perfect trade. This is taking the potential to break with all the momentum from the strong bottom, pinpointing where the market is most likely to continue, and capitalizing on those advantages. And Lonnie, you did it perfect. Great job. And then we get this one. It's the same look. Strong bottom, odds favorable, potential to break. Perfect entry. Money, money. And you say practicing a quick scalp ATM when it's not a clear path, and getting out before the term on the 13-2. Excuse me. So Lonnie, just to help you with your little scalping, this pink line is your first trouble. So when you talk about getting out at trouble, and that's exactly what the plan is on the 50-50, take one off at trouble, get to break even, and then remember that you wouldn't take this trade if you didn't anticipate that this area has that potential to break, right? So give it the chance on that second contract. That's what second contracts are for. Because when you exit here, look at this. Everything just keeps getting better. The market's going up, your small triggers are rolling, and your large chart never even blinks. And when you look at the KISS plan, Lonnie, it says first contract off at trouble. And then the second one, that blue line is an awesome target. A tick below, easy money. Another great trade. And now I have to beat you up, right? Because that's what I do. Strong bottom still, 50-50 works great. And now we've reached Fibonacci resistance. And that's a termination. And now the smalls are working their way inside of the large, and that's a loss of momentum. and you still take the entry, and that's okay, but you're void of advantages on the large chart. This is what we call letting the large or the small chart lead the way. And the small chart is the siren song. And it will talk you into bad decisions, Lonnie, because this says we already got there and we're losing momentum. And now we're hoping that it still goes up. Does that make sense? So if I were trying to design the perfect trade plan, never miss it, let it go. Because what happens, guys, is when price reaches an area and the triggers don't break, it's a termination condition. And rule number 2 came into place, and this is an 11-hour period. 36 times rule number 2 kept you out of a loser. 6 times, once it broke, you had the opportunity to trade to the next area. So we're playing the odds, right, Lonnie? Your advantage is gone. It's okay to miss this trade, and you're already in a 6-figure income. Great stuff, man. Great pictures, and you can feel that you're smoothing out, that you're getting your confidence. Your entries are freaking outstanding. And great entries, they do create manageable trades, even when one of the rules is gone. Absolutely. Great work. So, guys, that's what we're going to do in the second half of the day. But again, if you ever have to split early, let me know. We'll look at your charts, guys. I don't ever want you to miss out on the feedback. Knowing what you did right and wrong, getting that feedback, that's what's going to get you where to be. Lonnie, have a great day at work. Tell them you're getting good at your trading. It won't be work for long. That's everybody's goal, right? Take care, man. So going back into the entries, guys, one more time. Large chart says up. Large chart has momentum. Large chart has a clear path. Fear of missing out is gripping you. And then the reversal bar happens. And the reversal bar is not the entry. The reversal bar, rather, is the beginning of the fight, the beginning of the pullback, the loss of momentum. So identify where that retracement is most likely to go. Big red box, top of the triggers to the bottom of the triggers. Define where it's most likely to bounce, where the small crowd's most likely to fail, from the highest point of support to the lowest point of support inside of those trigger lines. This is your window of opportunity. This is where the failure is most likely to happen. And let me share something with you guys here. We're going to use some arrows. Price may retrace all the way to the bottom. Price may bounce from the highest point. Price may bounce from the lowest point. Price may blow through everything. And this is what you're looking at every time you take a trade. It could bounce from either of these. It's likely to trace all the way to the bottom. But because of the large chart advantages, you're going to be willing to put a limit order 2 ticks above the highest point. You're not going to trip over a couple pennies hoping to save a few dollars. Because with all of those advantages, it's hard for it to push lower. But if it does, if it gets all the way through the retracement zone, if it gets all the way through the areas inside of it, guys, any line below those triggers, I call this the wrong side of the triggers. Any line beyond the trigger lines, guys, this is not a part of the equation. This is not in the window. Once the market gets below the trigger lines, you don't know if, you don't know when, you don't know where that market is likely to continue up, if it continues up at all. So we're going to use that idea. Reversal bar, triggers, areas, take your entry. Understand that anything on the wrong side of the triggers is not a part of the equation. The advantage of rule number 3 is gone. None of these lines are part of the entry. And you're going to use that, and you're going to learn to call that area where the market should not go. If this is going to be part of my 70 to 80%, if this is going to be one of those winners, the market should not blow through all the trigger lines. The market should not blow through the areas inside of triggers. So your initial stop placement, and this is going to be in the plan that I give you, is 4 to 5 ticks beyond those triggers, because that's where your advantage is gone. That's where the market is no longer giving clear indication where it may bounce. And guys, 20 to 30% of the time, if you're following the rules for the high probability trend trade, 20 to 30% of the time, your stop will get hit. 20 to 30% of the time, you will take a loser. 20 to 30% of the time, you're going to question the methodology if you don't trust it because you didn't win. This is a cost of doing business. This is a normal part of a positive equity curve. Be willing to take a hickey. You don't get to pick the ones that win and lose, but you can identify a pattern that has been proven to win more than it loses. And guys, this is it all together. This is everything we've done in the first hour. When I have odds favorable momentum, let's flow chart it. If I have odds favorable momentum, well, then I'll look for a clear path. And if I have a clear path, I'll wait for the reversal bar. And once I get the reversal bar, I'll identify where the market is most likely to retrace. And then once I identify where the market is most likely to retrace, I will put a limit order 2 ticks above the highest point of support inside of that area. And I will activate that limit order and I will wait for the market to come get me because this is where my advantage lies. Does everybody see how the large chart in one bar went from full retracement and halfway to Profitville? All of this happens in one bar. That's the accuracy. That's the precision. So you're learning this pattern, guys. Does everybody see the tail on that large chart bar? These tails are the retracement. And when the rules are met, we'll see if that one fit. These both have the potential to break. When you go to a smaller, faster chart, this is how you're going to study, guys. Whoops. There it is. There's that one. Potential to break, pull back to support, right in the retracement zone. Pretty cool. There's your pattern. Let's back it up. Pull back to support, right inside of the triggers with the potential to break. Alpha, key holder, everybody that's new in here. Do you see the pattern? In a live market, it's going to feel like it's moving fast. In a live market, it's going to take you a second to develop some trust to keep your stop where the market shouldn't go. I fully understand that. But you can go back historically and look for that momentum and identify that path. Let's see if we can find one. There's a couple circles. Let's go see what these circles look like. This is part of the study process. Right back to resistance inside of triggers. A lot of indecision right at a key area, but ultimately, momentum wins with the push down. Right back to a mid-band in the retracement zone. A little bit of risk on that one. But sure enough, it pushes down. And if you scroll back and you start looking at these, you're going to realize that this pattern repeats itself all day long. This pattern is predictable. It's identifiable. It's repeatable. And if you do the work, you're going to realize that it does, in fact, win more than it loses. So how do you get good at it? Well, I'm glad you asked. This is Chart Reading 101. And guys, I promised you everything that you need. I'm dropping a zip file in the chat box right now called Everything You Need. So everything I'm about to present is inside of that zip file. The first one is Chart Reading 101, guys. The whole goal, the basis of this class is to get you looking at that large chart, to get you using one chart to identify momentum and path, because that's the core. Once you can do that, it's going to open up doors. So the path to glory isn't frustrating yourself trying to take a bunch of trades as a brand new user. It's taking pictures, guys. So those of you that I asked to download TechSmith Capture, did you get it? Because I promise you this is going to get you where you want to be sooner than later. Take 25 pictures each. Strong triggers and weak triggers. Clear path and termination condition. Start taking them. Annotate them. This is why it's strong. Separation, open scissors, colors match. And same with the weak triggers. Inside, scissors closed. Anything can happen, guys. Clear path terminations. Get them in the spreadsheet. Study them a little bit each day. Drop them in the room. Hey, Mark, am I reading this right? Because if you go through the process of taking 25 pictures each, guys, you're not going to accidentally trade without momentum. You're not going to accidentally. You have the charts, Alpha. You've got them right in front of you. Open a workspace. So this is crude oil. This is live crude oil. Let me show you how many lessons there are in one picture. And of course you want to annotate, but that's strong triggers, that's strong triggers, that's a termination, that's a termination, that's a termination. Potential entry, termination. There's a million opportunities. There's another termination. There's strong triggers again, strong triggers again. Annotate them, right? Start picking it apart. Alpha, you don't have to be in a live market. Watch this. We'll back it up and we'll do it again. Strong triggers, weak triggers, strong triggers. Termination with weak triggers. So over and over. All you have to do is open a workspace. And you can keep scrolling back. There's a million lessons. I love it. And the great thing is I'm not going to leave you on your own here. I'm going to give you this as well. This is high probability trend trade checklist. Alpha, is your software open? Is NinjaTrader open? Yeah, and keep asking. Oh, Alpha, open it up. Do you know how to open NinjaTrader? Have you done it yet? You and Chris are working together, right? Cool. So open up NinjaTrader. Go to those workspaces. Let's start looking at some stuff. Let's take some pictures. Let's simulate. Practice. Get in there. Break some eggs. Simulator it's the batting cages. Simulator is the driving range. Simulator is where you can go through and just keep practicing, and you can screw up everything. And there's no risk of loss. All you got to do is drop it in the room and let's have a conversation. So as you go take those pictures, this high probability trend trade checklist, this is designed to have you have the recognition. So this is designed to give you the best of the best entry, guys. Is it coming from a strong top or bottom? Which is a no triggers through termination that reverses the market. There's a strong top, termination. Once it reverses, it's a strong top. There's a strong bottom. First, it's a termination. Once it reverses, it's a strong bottom. Guys, you can take a high probability trend trade without it. If you look at the rules, strong top or bottom isn't one of the rules, but strong top or bottom gives you some warm fuzzies. As long as you have odds favorable momentum, not weakness. As long as you have a clear path, not a termination or the potential. And as long as you activate a limit order 2 ticks below or 2 ticks above the areas inside of triggers, guys. So this is all the pictures that you need to take to put into that spreadsheet. And then the second page is a checklist for you to print out to put on your desktop. So every time you're on that simulator and you're saying to yourself, I'm brand new, it's okay to make mistakes, but I want to try this. I want to get feedback. I want to just start to take pictures. I want to learn how to move stops. I want to learn how to do all these things. Guys, use the checklist. Police yourself. Because nobody in the history of this checklist has ever done worse than 70%. I've had engineers run it through like a 400-day scenario. They were more around 83 when the rules were met. And guys, all it is the simple rules defining your entry. That's all we've done for a whole hour, is defining the entries. I think you should write these rules on every trade that you take. Odds favorable momentum, yes or no, write it on a chart. Clear path, yes or no, write it on a chart. Area inside of triggers, write it on the chart. Reinforce the looks with the rules, guys. Tell me the whys every time you post in this room, because if you tell me why, you're writing a recipe to repeat success. So how do you get green and red back? Jason rebuilt the whole. So you don't have any templates on there right now, Jeffrey Dean. You need to right click on your large chart. Let me get to a large chart. You need to right click. You need to go to templates, load, and get that 13.2 in on your large chart. Get that 5.1 Renko bar on your small chart. Right now you got everything but indicators on that chart. So let's get those templates in there, and that should get you squared away. And guys, if you ever drop a tech question in the room, make sure you put tech question, Jeffrey. Otherwise, I might skip that until I go through everybody else's charts. I want to get you taken care of quickly. No worries. Where was I? There I was. Print it out, guys. Use it. Texas. Where was he? Absolutely right. I was in Texas. And now the plan. This is the KISS plan. Alpha and key holder. This plan's going to frustrate you when you start learning to read your charts because you're going to know there's more opportunities outside of this plan. This plan is a stepping stone in your learning journey, and it's designed to optimize your chances of success with the high probability trend trade as a new user. When I say optimize your chances of success, guys, this is the best of the best way I know how to teach this trade. This is the core. This is the foundation. This is the beginning. Through simulation, study, class feedback, and continuous practice, you'll be empowered to craft a plan tailored to your personal goals based on your experience reading the indicators. That's AI generated. Guys, when you can read your charts, you're going to see things. When you can read your charts, you'll manage differently. You'll find different opportunities. You'll be more patient. But until you can do that, this is your highest chance of success. And I'm going to tell you that I have had Nexgen users come in, brand new, never traded, learn these very basic rules, follow this very basic plan, and get funded in those prop firms in their first 30 days. So this plan goes on the premise and really the absolute. There's two things you have to know before you sit down to trade and you're not on simulator. You need to know why you're going to enter the trade. And the best answer is always because my rules are met. Because your rules are simply a description of a pattern that has been proven to win more than it loses. So when I say that, and I'm going to expand a little bit here and there, I'm saying this is the pattern that's been proven to win more than it loses. That's it. So every time this pattern is true, I know that I'm likely to win 7 to 8. I know that I'm likely to lose 2 to 3, which means I need to never miss this pattern because I don't want to mess with the statistics. Once you go through and you start circling tails, once you go through that spreadsheet and you start seeing just how often this pattern does produce winners, you're going to trust it. You're going to validate it. You're going to verify it. Don't take my word for it. Do the work. And you'll say to yourself, there's no way I'm not entering this trade because my pattern is in play, guys. And your rules are going to help remove the emotions of trading. There's a gentleman, unfortunately, he's no longer with us, Mark Douglas, guru in trading psychology. He said, imagine trading like a coin flip, but the coin has been weighted. So you know without hesitation, you have proven that that coin will land on heads 7 to 8 times every 10 flips. Would anyone in this room ever bet tails? Knowing that it's going to land on heads 7 to 8 times, wouldn't you just always bet heads, understanding that you'll lose a couple? You should. That's what rules are. And then you have to know why you're going to exit. And management, oh gosh, if you've never watched Mark Douglas videos, do yourself a favor. Do yourself a favor. No, the pot doesn't grow, Morgan. Why will I exit my trade? Guys, exits are either taken at profit targets or because your advantages are gone. And if you can look at your chart and say, I have momentum, I have a clear path, I have an entry area. Well, then you can look at your chart and say, I no longer have my advantages. It's time to get the hell out of this trade. So this is your KISS plan. This is the beginning. Define your entries, guys. Great entries create manageable trades. Great entries reduce risk. Great entries extend the distance to the profit targets. So great entries is all we've talked about for the last hour. Getting into the market where the market is most likely to continue. And then you have to manage it. This is where your pulse goes up a little bit. This is where your palms get sweaty. This is where that little devil comes in a poof of red. It sits on your shoulder and says, hey, Alpha, now you have something to lose. Key holder, they're going to come take your money. Change your plan. Guys, don't do it. Your management should be every bit as mechanical as your entry. So the management plan and the KISS plan, it's based on 2 contracts. We're going to enter with 2 contracts. And this is going to help you understand stop placement. And most importantly, and I can't stress this enough, this is going to be focused on getting you paid and getting you paid quickly. And then you will craft a plan tailored to your personal goals based on your experience reading the indicators. There's that AI phrase again. When you can read your charts, you might manage a little differently. When you can read your charts, your targets may get a little bigger. But until you can, why not focus on getting paid and understanding where stops go? So your KISS plan. Oh, and I have to ask, did any of you guys that haven't seen Moneyball, did you watch it over the weekend? Did you give yourself 2.5 hours to do nothing, all you go-getters? Base hits pay bills, guys. I'm telling you, watch that movie. So here's your if-then scenario, guys. If you saved it for trading today, right on. If entry is 2 ticks below resistance inside of triggers, then my initial stop is 4 to 5 ticks beyond the triggers, because this is where the market should not go. This is where my advantage is gone. This is where my advantage lies, all the way up to the top of the triggers. So I can't put a stop inside of those triggers. I can't put a stop below resistance inside of favorable large triggers. My initial stop is up here, 4 to 5 ticks, guys. And you will know your risk before you ever enter a trade. You'll know exactly where your stop goes. And you'll have to decide whether or not this $150 of risk per contract is something you're comfortable with. And I'm telling you, if you have all the advantages, you need to learn to be comfortable with that. Targets are predetermined. $100, $200. If you are changing your plan and trading the Dow or the RTY, better dad, right? Maybe your targets are $50 and $100, because this is really kind of a measure of distance rather than money. So if I enter where the market is most likely to continue, then my stop goes where the market shouldn't go. And I sit on my hands and I do nothing. And they're either going to stop me out and I'm going to take the loser, or I'm going to accept the loser as a normal part of a positive equity curve, or I'm going to get a reversal bar in the direction of my trade. And this is what we call a confirmation bar. It is confirming that the market is going down with odds favorable momentum. It is confirming that the market is going down with a clear path. It is confirming that the market has in fact bounced off the area inside of favorable large triggers, and now it's going down. Which means you can redefine where the market should not go. And your new stop is going to be 2 ticks above that reversal bar. And it doesn't guarantee a winner, but what happens is you've gone from $150 risk to $30 risk per contract in this trade. And then once again, your hands go in the air. You're either going to get stopped out for a smaller loss, or it's going to go to your first profit target. If price reaches your first target, there's that if then, one contract is automatically removed. Those funds go into your account. You're a winner. Your palms stop sweating. Your heart stops racing. You unpucker the pleat that you put into your chair. And guys, you made money. You're successful. That's where confidence comes from. That's why it's such a quick target. And you're going to move your stop to break even. You're going to take 100% of the risk off that trade. And you're going to do that not because it's the best stop. You'll create a plan later. You're doing it because the only reason, that you got into this trade in the first place is because your large chart is screaming to the downside with absolutely nothing in the way. And guys, it's more likely to go to your second target than it is to stop you out. And if it goes to your second target, you're out. You're done. You've exited. No matter what happens next, you are no longer a part of that trade. But you just made $300. And now show of hands, guys, work with me here because we've all thought it. Mark, $300 isn't enough. $300, that's not a successful trading day. $300, I can't make a living. I can't replace my current job with $300 a day. Guys, this is 4 minutes. 4 minutes of your trading day. And if that $300 is the best you do every day, that's a $75,000 year. Have you guys ever heard of trade copiers? Where you could take that same $300 trade, mirror it on 2 other accounts, turn it into a $900 trade, and all of a sudden that 4 minutes of your life, if that's the best you do every day, is $250,000. And that's the goal, guys, is consistent profits. Consistent profits daily. Pete, you use your... So Joel, there are trade copiers. John Novak is building one. Well, actually, it's already built. So when our funding company opens, hopefully in the next week or two, what you can do, let me see if mine's in here. So what I do is I have a leader account. And then, Joel, I have 2 follower accounts, which means every time I take a trade in my leader account, it's mirrored on a copier account. Which means that if I took a $100 trade, it's actually a $300 trade. And if I took a $300 trade, it's actually a $900 trade. And that's one of the great things. So if you're focused on the best, if you're focused on the highest probability, you don't have to make $1,000 a day. You can make $250 a day on 4 accounts. That's the goal, isn't it? But better, Dad, it's never about the money, guys. It's about the process. Can you repeat the process? So in that zip file I gave you, that everything you need zip file, you have your foundation. Let's learn to read charts. Let's take a lot of pictures, right? You have the high probability trend trade checklist, what it looks like to have your rules met in every scenario. You have a KISS plan that gives you the best of the best. The best of the best. And then that best of the best takes you to your second trade. And that second trade is the 50-50 trade. That second trade is the trade that uses the potential to break. But you have to understand a strong top or bottom. You've got to be able to recognize momentum. You need to know what divergence is so you can avoid it, because that's the biggest killer of the 50-50 trade. And the management's different as well, guys. So keep it basic in the beginning and let that carry you to the next level. Also in there, let me double check, is this one, the pictures you can take. So Kelly Key, everybody, take pictures before you get into the market. Take pictures during the trade. Use it for management. Take pictures after the trade, start to finish. This is the one you're going to annotate with all the things that I need. And take pictures when your rules aren't met. Remind yourself, rules are your lifeline. If my rules aren't met, it doesn't cost anything to take a picture, to write the analysis, to say, hey, this isn't my trade. And you may find that these are your trades later in life. But you're building a copy, guys. So take a lot of pictures. And then also in there is this one. So this is good news for you new guys. Everything that we've done in the last hour and a half, and I drug today out a little bit because we've got new users. This reminds you in this document, guys, 5 days every week. Nexgen is going to teach you 3 rules on 2 charts. You're going to recognize advantages. You're going to turn those into trades. It goes through the advantages, where to find them, what they look like, the indicators. It breaks them down individually, and it takes you all the way through the entry and how to study. Everything that we've done in the last hour is consolidated into 2 pages. And inside of that file as well is the PowerPoint that I use to teach every day. So every morning I very arrogantly say, I'm going to give you everything that you need to be successful with the software. So I've given you rules. We've talked about them individually. You now know how to study them, and you have a spreadsheet to put them in so you could go back to study them. You have the ability to simulate. You have 15 hours every week to get feedback live in this room on everything that you do and see. The only way you don't get a question answered with Nexgen is if you refuse to ask it. The people that post the most typically get to where they want to be. The people that use a spreadsheet typically get to where they want to be faster, guys. You've been given a plan. You have to learn how to follow it. And while you learn how to follow it, post in the room, ask questions, make sure that you're reading it. So the key to everything, this is the last thing, then I'm going to take a break because I think breaks are important. The key to everything, to all of this, is having a foundation, understanding the basics, and then compounding a bit. So for you new users, I blanket you with very conservative rules. Recognition of advantages, a solid plan that optimizes the chances of success as you learn to read your indicators. So for you new users, all termination conditions are bad. No momentum, sucks. No areas inside of triggers, oh, it's the kiss of death, don't do it. That's what it feels like. These are blanket rules because it optimizes your chances of success. It increases that likelihood of success. They're not always bad. If I'm not mistaken, the first trade that I show you from one of our users is going to be directly into a termination condition. But there's a lot of great things going on with it. Just like anything, the more time you spend with it, the more you're going to see. It opens doors, guys. But you've got to learn the process that yields the results. This is another Mark Douglas thing. It's not about the wins and losses. It's about the flawless execution of a plan that has been proven to produce more wins than losses, guys. So if you keep it basic, like the KISS plan, if you follow simple rules, if you're okay not being in every trade, but rather you insist on being in the best trades, you can find an extraordinary level of success as a brand new user. I've been watching it for years, guys. But the further you deviate from simple, the longer you take to get to where you want to be. The more you chase, the less perfection you find. So question everything. This is the most important part of my classroom. Question everything. Never sit silent. Always, always, always. I don't care what it is. Mark, what's that pink dot? Post it in the room. Mark, is this a termination? Post it in the room. Mark, I took this trade. I'm not sure if it follows the rules. Hell, let's look at your trade. Because you posted in the room, let's write the rules on it together and see where we're at. Question everything. But give yourself a little grace, guys. You're brand new. It's okay to be. This is a brand new skill set. In the same way when you went to college to be that engineer, they didn't let you build bridges. Not on your first week. You're going to kill somebody. Take the time to learn. So when I come back in the second hour, we are going to look at all of your charts, and we're just going to go back to rules. And I'm going to identify the good, the bad, the ugly, and we're always going to discuss momentum, path, and entry because I want the new users to get the lessons out of it too. So if you're one of my users that doesn't mind trading into a termination condition, don't get in your feels when I tell you that you're trading into a termination condition. Maybe that's not for you. That might be for keyholder who's learning to identify a termination condition. I'm not the trade police. I encourage you not to be the trade police. We'll go back to advantages, and if there's anything I can give you to do it better, I will give it to you to do better. So go stretch your legs, guys. The crude oil market is directly into a termination condition. So we're going to relax. I'll see you in 5. All right, cool kids. We're going to get into the second hour now. So, what do we think about crude oil? So, I want to ask you newer folks. Can you see the momentum? The smalls are above the large are getting wide, the spaces between, the scissors are open. Key holder, does that make sense? Who else is brand new in here? Where are we at? I've got a couple friends that use it, Mike, and they love it. And look how the momentum is still pushing. And now we have the potential to break these areas. Wow, look at it go. And if I got a pullback, I've got support inside of triggers with the potential to break. Pretty cool, right? I'm only piecing advantages together. So what we're going to do is we're going to go back and take a look and see what you guys have been doing. Scrolling up to the very top of the room, and Pete got us going, and I knew that Pete was going to give us a great lesson today. And guys, I may have a zip file. Let me see. Maybe not. Sorry, I was looking to see if I had that copier for you guys, and I think I got rid of it because I was having some challenges. All right, so Pete says, check it out, Mark. Strong bottom. Small triggers, large triggers didn't break through the fib. The market reverses its odds favorable momentum. They're up, they're separated, they're strong 100%. And then he says, I have one of those 50-50 looks. And guys, he absolutely does. On this 68.61, the small triggers are up, the large triggers aren't through, but the one thing about this trade is that 50-50 is an incorrect read from the very basic core of what we talk about in this room. Because every time price reaches Fibonacci resistance and the trigger lines remain below, you have to say to yourself, this is an area that could stop the market. This is an area that could create an untradeable bounce. You'll notice that his entry is perfect. It's virtually no risk. And his management is aggressive. He's out. He doesn't care what happens next because he knows he's trading into trouble. And guys, Pete will annotate his charts for Pete, not for me. But I've been watching Pete trade enough, and I want you to see this. Knowing that you're trading into a term, it lets you make a choice. You can choose whether or not you want to trade into that termination condition. And knowing what you're up against can set you up for aggressive management, taking those quick profits. And this is a great example of Pete taking his advantages, strong bottom, strong triggers, everything matches, low risk, and then pushing up against, well, this is an area that could stop the market, but with all of this momentum coming from a strong bottom with this virtually no risk entry, I'm willing to take a chance. Pete's willing to take a chance. And guys, this is 62 to 75 is 13 ticks. And just to give you guys a little insight, on how you don't have to be in giant moves to make money, that's a $2,600 trade for Pete. It lasted a couple seconds. He knew where his challenge was. The risk was virtually nothing. And he didn't hope. And Pete, that's like the best part of it. Your chart reading said I have this plus this plus this plus this plus this. This is a negative. Let me use all that momentum to get back to the negative. And you did it freaking amazing. Great job, Pete. And guys, this is why I don't beat you up for trading into termination conditions. Because when you know what you're up against, you get to make the decision. I don't tell you guys when to trade. But Pete put on a clinic on how you can trade into a termination condition because of momentum, and it works out. Nicely done, Pete. And We saw Lonnie's and Pete again. Let's see what he did. Termination, odds favorable, clear path, and what Pete did, and I really like this here, is so Pete took what's called a chili dog, and I think it's funny because the chili dog trade is not a Nexgen trade. It was created by a gentleman that's been in this room for, goodness, a year and a half now. And it's based 100% on momentum and path. And when you have the strongest triggers ever, and price bars break below those key Fibonacci areas, and you see how Pete let his price bar get below the trouble. Let me get away from, I did skip that one. I realize that. Can we call it my lazy eye, Pete? That's okay. The lesson is still the same. We'll just do it on both. I remember your annotations. Pete has a 50-50 look. He lets his price bars get away from the decision-making point. He lets his price bar get away from the decision-making point, and he rides momentum all the way down to a loss of momentum. And it's a beautiful, beautiful trade that doesn't have anything to do with a pullback to an area inside of triggers. It's Pete, once again, using a chart read to find a way to capitalize. Guys, there's so many opportunities coming. And then, odds favorable momentum, clear path, and Pete, your entry was 2 ticks below those yellow 1-to-1s. You chose not to take it. And then you almost took it on the pullback to the mid-band, but divergence said wait for a confirmation bar, and it never came, so no trade. And you know what? Honestly, Pete, with this look on the large chart, you're making a decision. You're a couple ticks above support, divergence prints, triggers weakened. You're like, and I love this. Pete's not comfortable with the entry here. Pete says, I know there's a lot of advantages, but it just seems a little bit off. Let me force the reversal bar and I'll take the trade. And he never got it. He never took the trade. And that's one of the things is you guys will get to the point to where you'll say, hey, I don't like it. And you won't feel like you have to be in a trade. You won't feel like you have to take a trade. And you'll get to that point, and I think these are the ones that I missed. Yeah, so we talked about that one. Winner, winner, chicken dinner. Up 8,100 at, oh, that's 1 o'clock. $8,100 trade. So the greatest thing, I think, is when you begin to recognize patterns, when you begin to see these things repeat themselves, when you start to believe that the next trade is coming. And guys, the next trade is always coming. It creates this patience. It creates this willingness to not chase, to not be in a trade if it's not perfect. And you really begin to take command of your emotions the more you trust your plan. So Pete, absolutely beautiful trading. Great job. Solid looks everywhere and consistent. All right, Joel. And that's perfect. So Pete recognized a pattern and learned how to avoid it. All right, triggers still going up. Room to target. Where the market is supposed to go, your window of entry inside a trigger, so your stop is below it. And looks like you took a momentum trade here, Joel. That little snap back to the fib. Was that your intention? Cool. So let's talk management. And there's 2 ways to manage these, and I don't think either one is wrong. And I want to do this. And this may be a lesson that you don't need, Joel. If my reason for entry is momentum, I'll let a loss of momentum take me out. That's one way to manage a momentum trade. So as long as price doesn't close below the triggers, it's going to keep going up. And that's just, it's a fact. Let me find it. You know, I've got pictures for everything. So if I'm only in momentum, as long as I don't get that reversal bar on the wrong side of the triggers, it's going up. For me, this reversal bar signals the loss of momentum. That's an exit condition. That's my advantage going away. And that's just me, Joel. And that means that I'm taking a 2-point trade. I'm taking a $50, $100 trade there. Or even more, I'm taking $100 on the way up and getting out because I know momentum goes away. And this is pretty cool. You've got momentum. Your path is clearing. And you say, well, if it pulls back to support inside of triggers, hell, that's a trend trade, right? And the only thing about this one, Joel, is this line. Whoops, that's not a line at all. Come on now. Is this line is the lowest point of your triggers? And that's at 19, which means instead of 16.25, Joel, the appropriate stop for a trend trade where the market should not go is somewhere here around 18, which means that you could take about 6 ticks of risk off that trade and still be where the market shouldn't go. Does that make sense? It's not below the areas on the wrong side of the triggers, because the areas on the wrong side of the triggers, hell, who knows if it's going to stop it. It may go all the way down to this mid-band. So just a little less risk on that one, I think, would have been appropriate if you had chosen to do that. Nice trade, Joel. I love the momentum trade. I like getting paid quick on momentum trades. One of the ideas in the room, it did go below all of it. Is, and I'm going to go back to Ron, on that chili dog trade, on those momentum trades, typically $100 in a tick is not a guarantee, but it's the most likelihood bit of success. So if you're in at what is that, 69 and a quarter or 19 and a quarter, right up here at 2150, that's a $250 trade or $225 trade on the S&P, and you're out before the loss of momentum even happens. And that's one of the things, and that goes back to that idea that base hits pay bills, that base hits are more than enough. Because if you take that trade 3 times, hell, that's a $600 day. That's a pretty impressive day. Great trade. And then let's see, who's next? Roy, how you doing, Roy? Roy says, check it out, Mark. Good top, yep. Odds favorable, absolutely. Waited to cross the support fib. I am going to say, let's see. So you are in at 57. So Roy, I like it. I really do. You're saying because of a strong top, because of odds favorable momentum, you're really kind of, you're flirting with it a little bit. You're trading directly into a termination condition, and a tick or two below a fib isn't as safe as you guys believe it is. And let me show you why. And then I'm gonna give the second half of that. I'm not just gonna say, oh man, I'm gonna give you my take on it as well. So when these fibs are created, ladies and gentlemen, your software goes back 10 days, and it measures every up, every down, every swing, and it does these Fibonacci retracements, and it looks like this. And any of you guys my age remember the old Atari game Yar's Revenge. It looks like Yar's Revenge. And it is literally tens of thousands of calculations, and then the algorithm comes in, things that make you surprised how smart your siblings were, and it starts to weigh them, and it starts to sort them. So what happens is this fib is based on thousands of calculations. So a couple ticks above it, a couple ticks below it. Guys, it's still the area that created this area. So one of the things you can do when you're like, all right, I'm going to let it get below that area, let the price bar on that small chart, be willing to sacrifice a couple ticks, get the price bar away from the decision-making zone, and at least it gives you a better chance. Because here we got to tick below and look at the bounce, right? And you see that a lot. And here we got a couple ticks above, and you still got the bounce. So by letting the back of that price bar, it costs you a couple ticks, but I think it helps a little bit. And then Roy, I love your exit. You're like, okay, my momentum's gone. What a great trade, dude. What a great trade. And you're recognizing the strength up top, and you're identifying that momentum. And man, that creates warm fuzzies. It really does. You get excited about taking trades with those advantages. All right. Is this Sid? Is that right? I got lost. Hold on. I got lost. Jeffrey. Okay, Sid. So Sid, I'm not going to lie. This is hard to read, brother. Okay, hold on. Entry over here. Exit up here. There we go. I'm sorry. The arrows are pointing this way and that way. I got confused. So let's look at your small chart. Large chart is screaming up with the potential to break. Small chart lets you get above anything that could be problematic, and you exit before you get to trouble. Does that sound about right, Sid? You didn't really give me any whys on here. How do we repeat this one? So this says you got in here, and it says that you got out here, and you made $30. You made 6 ticks on that trade. One of those ticks went to commissions. So you made about $23 on this trade. Sid, is it worth it to you to take $23 trades? It might be. Okay, so Sid, let's go through, and you've heard this before. Why did you enter there? And why did you exit here when everything was strong? Why didn't you go to trouble and turn that $23 trade into a $123 trade? And with the large chart screaming north with absolutely nothing in the way, what inspired you to exit at all? Every chart, every indicator was all screaming, and you chose to exit. And Sid, if you take a second to tell me why, we can address it and we can talk about how you might have been able to hold for bigger moves. See that fib that created the first bounce? What a great target. Those 1-to-1s, what a great target. Because this chart doesn't say you're slowing down at all. Does that make sense? And guys, I know I sound like a broken record, and some of you are just like, F you, Mark, I'm not going to annotate the way you want me to annotate. And that's okay, that's your right. But if you write the whys, it becomes repeatable. If you write the whys, when you go back and look at it, you know what you were thinking. I took an exit here because I had these 1-to-1s. And if I took an exit right here, eventually, I'm going to write, I took an exit here because I was chicken shit and I didn't want to give any back. I didn't have a reason to exit. Everything's set up. And what I can do is I can annotate my chart and say, I'm going to show you exactly what I mean. So I'm hypothetical, and Sid, this may not have been your reasoning at all. I entered because large chart, odds favorable momentum, clear path, got above the divergence high, so small was clear. With momentum, everything was great, right? And then this is where I have to turn it into a management plan. Exited because I didn't want to give any money back. And I don't care if that's the reason or not. It doesn't matter. I'm not here to judge you on why you exited. I'm here to say, with all charts up, strong, clear, I can hold this trade for larger profits to an area that could create a bounce. So Sid, what we've done is we've gone from entry exit to this is why I got in. Let's make that repeatable because I love everything about it. What a great plan. But now we got to turn these great entries into a little bit of money, right? And if you take the time to first acknowledge that you puckered, right? I don't want to give it back, so I'll take 20 ticks. Just don't even bother ending the trade. And you turn your pucker factor into a plan how to avoid the pucker. So Sid, next time you take this great entry, you're like, I'm holding to trouble, man. I'm holding to trouble because every chart says I'm more likely to make it to this fib than it is to just peter out in the middle of everything if odds favorable. I hope that makes sense. Entry is rock solid reasoning. And now we just work on management a little bit. Let's learn how to turn those great entries into cash. Because the read was great. The patience was awesome. And Sid, I'm gonna do a little admission here, okay? And you may think I'm doing this to make you feel better, and maybe I am a little bit. But Sid, when I first started trading, I blew myself out of the water. It took me 2 hours and 21 trades to lose $5,000. True story. $5,000 was gone in about literally 2 hours. And Sid, every trade that I took after that, and I'm going to show you, I would have this awesome entry at 1925, and then I would exit at 19 or 26 because I got scared of losing. And then I would take an awesome entry at 68.57, and I would be out at 68.56 because I was afraid of losing. And my awesome entry, I would take a quick exit because I was afraid of losing. And Sid, it was hilarious because I would take 25 trades and I'd be down $100 in commission on 90% winners. And it was ridiculous. And I realized that, and I'm telling you, I had to go back to Sim, Sid, and I had to have a plan in place. I had to have something that was rock solid. I had to have something in place to follow so I could develop trust, so I could get over being hurt. Get out there and start dating the trading pool again. And I think that that's one of the great things about Simulator is it doesn't matter if you win or lose on Simulator. It's all for lessons. So when you take your entry, yeah, just let it run. You're on Sim. And what it also does is even if it did turn right there and run you over for some reason, then you'd have that data. So I love it. I'm not knocking you at all because you're right where everybody who's learning to manage ends up. Management's the scary part of trading, I think. I think entries are easy. I really do. I think entries become very second nature very, very quickly. And that's why the KISS plan is so pragmatic. All right, better dad. Strong bottom? Yep. Odds favorable? Yep. Clear path? No. Not even a not really. It's a no. Didn't let the large trigger complete through the fib. It's opium. Entered a tick above the 1-to-1 and stopped out. No surprise. On Simulator though, right, better dad? Dog didn't bite you, wife didn't leave you. Nobody repossessed your simulator car, right? So what's the great lesson? Divergence and weak triggers on a 50-50, you're more likely to lose than win. Follow the rules. But better dad, I think it's more important to break the rules every now and then. Because now you're starting to see why the rules are the rules. You learn more. Guys, you learn more off of losers and mistakes than you ever will off of easy wins. And it's this one right here, better dad. Strong bottom is great. Strong bottom is where this 50-50 has a super high chance of winning. But now we're into the next area, and it's not just one area. Did you notice that it's a 10-point range? It's from 22 to 32 that's still not broken. That's a pretty big gap. So you're hoping momentum not only breaks 22, but you're also hoping it breaks 32. So you're not even clear until like 46 or something, right where it reversed. And then divergence and weak triggers. Divergence and weak triggers. It takes momentum to break areas. Great lesson. Thank you. Great lesson. Strong bottom. Odds favorable. Potential to break. Pull back. Stop gets you out of trouble. Nice job. Joel, he can do whatever he wants. That's the beauty of it. He can do whatever he wants. I don't know if there was a continuation trade in there. I don't have enough information. And this is one of those ones. It's virtually the same look. It's a strong bottom. It's strong triggers. But do you see what the big difference is here, Better Dad? Here you have one line that you're hoping breaks. In the previous trade, you had a huge range that you were hoping would break. In this trade, smalls are still outside of the large. In this trade, they've already gone inside of the large. Do you see the subtle differences? And the results are different. Yeah, they're so close, but these are the things that you'll begin to notice. Termination, odds favorable, clear path. And you waited for confirmation. You said, my entry isn't perfect. Let me wait for confirmation. And what a beautiful trade here too. Guys, this is your right as a trader. If I enter at the mid band, that's too much risk. I'm not comfortable with that. I'll enter with confirmation from the higher point, establish my risk, and give me more room to profit targets. You did it great. You did it awesome. And then I don't see a short trade into the gap, which is even better. Nicely done. Did you recognize that big old gap? Because I know you're working on that. Start seeing that thing everywhere. More after the fact, that's okay. All right, Jen. Nexgen trade. Which Nexgen trade is this? It was a good look. Termination and momentum. The one that says when you have no triggers through a termination, sell a pullback to the small triggers. Hold on, let me make sure. Jen's like, I haven't posted in a week, and this jerk is going to come after me on this one. Jen, it's okay. You had the right idea. So, termination first. Small triggers roll on the large chart. Sell a pullback to the small. That's the one that you were thinking of. There's no doubt about it. That's the one you were thinking of. Couple things didn't quite happen. You didn't get the large chart small triggers to roll yet. You let the small triggers roll on the small chart, which is cool, right? But everything is still up, and you are directly into support with everything still up. Little risky. Does that make sense? But I'll tell you what, you took a risky trade with conviction. So I admire the confidence. I admire the confidence. And guys, I'm telling you, we all make mistakes. Normally, Jen, what that would look like if it actually set up, and it really didn't for you, is there would be a sell. Gosh, I hate it when I do that. Never mind, hate's a strong word. Typically, there's a sell somewhere about right here, And it looks about like that. It looks like the pullback. A lot of times you get a little snapback to those large triggers because they're kind of in line with the small triggers. And I think that's the trade you were looking for. Good stuff, though. Good stuff. And I'll tell you what, if you're going to make a mistake and win, right? Uh-oh. Jeffrey Dean, what are you doing to me here? Why is it asking me to log into my TechSmith to see your stuff? I'm going to do it. And now the page is not found. Jeffrey, I think, hold on, maybe that question mark. Copy link. Jeffrey, would you mind reposting that? I'm struggling with it here. I can't get it to open. Thank you. Maybe it was the question mark. I'm missing my stops and limits. Still checking on this rebuild from this morning. Okay. You do have your ATM strategy in there. Hey, Jeffrey, before we even talk about that, can I say nice job? This is so different than what you've been showing me for the last month. This is freaking awesome. Nice job. I know you're not asking about the trade, but nice job. So they're not working. Do this for me. Let's do this real quick. Go to your ATM strategy, no matter what it is, and hit the edit button for me. And just make sure that everything is put together in here. And I don't know why it wouldn't be. But make sure that you've got quantity 1 on your targets. Make sure that your stop loss is at a number and not a 0. And I'm not sure why that would be in there or not in there. Do you know how to put them in manually? If you find yourself in a trade and your stops and targets don't show up, do you know how to put them in manually? Cool, guys. So this is a great lesson. I'm going to do this. If I buy the market, whoops, hold on. Let me get rid of this. So let's say I buy the market and I'm like, oh my gosh, I'm in a trade, but I don't have stops and targets. So it's a buy. What's the opposite of buy? Sell. So to exit, I'm going to right click down here and I'm going to put sell stop market 2. And that's going to be the first one I do, is I'm going to protect myself. And then again, the opposite of buy is sell. So maybe I come to the fib and I go sell limit 2. So now I've got my sell orders in, 1 to protect me, and I've got 1 to pull profits. And then here's what happens, is if it hits one or the other, hit my stop, I have to cancel the other side or it's going to put me in the position. So even if I sell the market, a buy stop market will be my protection, a buy limit order will be my target. If it hits my stop, whoops. If it hits my stop, I have to cancel out the other side. So if you ever do that, if you ever find yourself, oh my gosh, I'm in this trade and I don't have stops and targets, it's a quick right click. And I would encourage you guys, go practice that on Simulate a little bit. Practice getting in without a stop or a target. And if you want to do split targets, drop it down to 1 contract, sell limit 1. Sell limit 1, and then go back to 2 contracts because that's what we're in. Sell stop limit market 2. quantity. Okay, so change your stop loss. Your order quantity is 2. Your target 1 is quantity 2. What market is this? Just for grins, put your stop loss at 12. Put your profit target, it doesn't even matter, at 10. Okay. So here, let's go through it real quick together. I'm going to right click. I'll do the KISS plan real quick. So we're going to edit it. So let me give you something to look at. And I'll give you a template to go by. So this is the KISS plan crude oil. Order quantity 2. And then what you're going to have to do, Jeffrey, is you're going to have to add one more. And when you click that add button, it's going to give you the second target. So target 1 is quantity 1, stop loss 12, profit 10. That's your 10 ticks. Target 2, quantity 1, stop loss 12, profit 20. That's your $200. So drop those in there and then hit save as template. If you hit save as template, you can call it KISS crude oil. Let me know if that works for you. It should. I'm not super techie, but I'm kind of techie. I'm techie-ish. All right, Joel. As my kids say, I am tech adjacent. All right, Joel. We saw this one earlier. Triggers up, room to target. You take the momentum trade. Joel, I think you double posted me. Was that intentional? Did you like the feedback so much you wanted to hear it again? Kidding. Morgan, odds favorable. Potential to break, weak bottom, no divergence, perfect entry, money, and then you get out quick. Long hold for what I was hoping was going to be in the fib, but alas, I went out on a reversal. That market didn't reverse. You got a couple bars against it. Nice trade, Morgan. Nice trade. JK. Same, but better. Morgan, it's not a competition, but you lost this one. JK did it better. I love it, guys. Perfect entries. Perfect entries. Get paid. What did you want to ask, Morgan? When the triggers are split? Okay. You know we're going back to Sunday school on this one, right? Reversal bar prints. Where may the market retrace? From the top of the triggers to the bottom of the triggers, right, Morgan? It could bounce anywhere in this range. Does that make sense? Cool. So you have to make a decision. Do you want to get in at the highest point? Or do you want to get in at the lowest point? Do you want more risk or less risk on a medium probability trade? That's it. Or do you want to force confirmation? So that's the decision you have to make, Morgan. You know where the market may retrace. You know where it's most likely to bounce. Are you willing to miss the trade by getting in lower? So if the triggers are split, let's just use language. I love language. If the triggers are split, they're not favorable, right? That's the best look always. You don't, Joel. Joel, you will never know anything, ever. 100%, never. Promise you that. You'll never know anything. You'll never have an absolute answer, ever. But here's what you do know. You do know, and you'll like this, I think, I hope. You do know, Joel, that if you took 1,000 pictures of retracements on an entry chart, it's most likely to retrace somewhere from the top line to the bottom line. And you never know where it's going to be. Does that make sense? But you can identify a pattern where it's likely to go. And Joel, you never know if it's going to bounce from an area inside, but you know that it's more likely to bounce from an area inside. And that's what we're doing, is we're trading a pattern. That's it. And Joel, once you get below those triggers, you're already through where it's most likely to retrace. And if you get to the other side of those triggers, you're already past where it's most likely to bounce. Which means down here, the advantages are gone. And this is one of the things. How do I know it's going to bounce off of there? You don't. You don't have any freaking idea. But what you do know, hold on, let me find it. Let me find it. You do know that if the pattern is true, it is more likely to bounce off the areas inside than it is not. And if the pattern is true, if it blows below those triggers, you're no longer in the pattern's true scenario, and that becomes an exit. I love that question. Mark, how do I know if a fib is going to hold? I don't. How do I know if an area is going to break? I don't. All I can do is trade my patterns and hope for the best. Does that make sense? And yeah, Morgan, you're asking the same thing. How do I know which one to get in at? You don't. You have to pick one. But this is why the language is so specific when I teach entries. And Joel, this is a great example. The market's going to most likely retrace from the top of the triggers to the bottom of the triggers. And it's most likely to bounce from one of the areas in that retracement zone. And if you know where your risk is, you can choose the lower risk entry with the understanding that you may miss the trade. You could take the higher risk entry with the understanding that if you lose this trade, it's a bigger loser. No, so Morgan, you have to think about it this way. Okay, that helps, right? This line represents where the retracement is most likely to occur. I think that's the most important part because it's that retracement zone that gives you the ability to have an intelligent stop. This is where it's most likely to bounce, right? And again, that's why the stop is down here. So the cool thing is, I can decide if I want 17 ticks of risk and not risk missing this one, if it goes from the midband, or less risk at the fib, from the fib, or I can choose to take less risk from a midband. Stop is same for both. But let's look at the difference though, right? Because this area is not broken, and this area is not broken, and it's not a strong bottom, Morgan. Do you want the most risk on a trade with the fewest large chart advantages? Maybe not. You might even just insist, I want the up bar. Why? Because if I get the up bar, I'm still in at the fib price, but I knocked 10 points, 10 ticks of risk off my trade. Does that make sense? So for brand new users, it's the highest point of support in the retracement zone. As you grow with the software a little bit, guys, you're literally going to start weighing these things out in a fraction of a second. But I think one of my favorite phrases, and Paul, he's not in here today. If the trade isn't perfect, I want the least amount of risk. And you'll always know where the risk has to be because of those triggers. Good stuff. Good lessons there. Thanks, Morgan. JK took it lower as well and got out going into trouble because it's a medium probability trade. Nothing wrong with getting paid, guys. You're welcome, Morgan. Nothing wrong with getting paid. Joel, odds favorable, potential to break, perfect entry, great money, exit with divergence because divergence kills medium probability trades. Great job, Joel. Same trade. Other Joel. 50-50 with momentum. It's the only way to have it. Beautiful entry at the high end of the range. Stops where the market shouldn't go. The only challenge with this one that I really see, Joel? No, Joel. Is divergence. So Joel, what you're doing is you're making up rules that you think create safety, or you're trying. Your brain's trying to. I'm not saying you're doing it consciously. Well, if I get in all the way up here, doesn't that reduce risk? Absolutely, but it puts you on the wrong side of 4 different bouncy things that are more likely to stop the market. Does that make sense, Joel? What if you get in at the area in the retracement zone, right? And you accept the risk. So on this one, Joel, you could have gotten in at a mid-band. You could have gotten in at a fib. You chose to get in below the fib in the synthetic. It went to the 1-to-1, right? We're good at pinpointing where the market is most likely to continue, understanding where it shouldn't go. The amount of risk is up to you guys. My brother has this phrase, and I love this phrase. Are you going to trip over pennies to save a few dollars? Are you going to take the lowest risk entry every time and risk missing all of those trades? And how do you suppose missing the perfect trade because you weren't willing to put the risk on it is going to affect your decision making 3 or 4 missed trades down the road? Does that make sense, Joel? There is no better. Is a blonde better than a redhead, better than a brunette? Hell, it depends on who you ask. Is chocolate better than strawberry? Right? It's just got to be right for you. So, Joel, let me give you something else. If you're fearful, and I'm not saying that you are, if you're fearful, and you're like, this is too much risk, and this is still scary because of the risk, enter on the confirmation bar. Because then at least, not only has the market gone in the direction of your trade, but you've got something to put your stop 2 ticks below. And I see a lot of people, Joel, as they begin to grow their trust in the methodology. They're not there yet. Nobody's there in the beginning. It's freaking terrifying to buy a market on its way down in the beginning. I know that it is. I've been there. A lot of people wait for this confirmation bar, and that way their risk is established. Does that make sense? So you're like, I don't know, that's a big window. And on your trade, you might say, I don't know, that's a big window. Let me force it to go down. I'll get in right here, but at least then my stop is where the stop belongs. Million ways to use this software, guys. None of them better than the other. But Joel, that's a great example of if you're not cool with the risk, shoot, force it to do what you want it to do. Force it to do what you want it to do. Hey, Jeffrey, did you get fixed? Did it work? You good? Cool. You guys got to tell me. I'm a worrier. You're welcome. You're welcome, Joel. And for those of you that are new in my room, this is how we all get to where we want to be. And a lot of times it's just, hey, Mark, I'm going to throw a scenario at you. Let's talk about it, right? And we'll play it out from a chart reading standpoint. And I'll incorporate all my own fearful trading that I've done in my life and see if I see a resemblance. And we'll talk about how I fixed it and how maybe you can fix it. Boaz is the most boring trader in the history of traders because he loves momentum and a clear path. And he will take that pullback. And look at this. This is kind of both of them. He takes the pullback, doesn't get stopped out, and he goes, oh my gosh, this is such a good trade. Let me get a second contract on that one on the way up. And then money and money. What a beautiful trade. Great job, Boaz. There's an elegant flow to your charts. Like, it's just, I don't know, it's like dancing. It's so in tune with everything. I love it. All right, who's this? Joel again. Let's see what happens. Great top. I agree. Odds favorable. I agree. How's your path? Clear path, 50-50. What do you think, Joel? So you are odds favorable, clear path, right? And here's the challenge. Are you ready? Because of the nature of the triggers, how wide they are, and the great top that we have, I'm anticipating the market to break the fibs. So Joel, you just imposed your will on a market that doesn't give two shits about your will. Does that make sense? Well, with this look, it has to break the fibs. So let me put all my targets below the thing that could stop the market cold. Hey Joel, look at that momentum and that great top, and look at that big nasty bounce that it created. Why would this line be any different? This has two areas. Does that make sense? Got your entry? Crazy large stop. And then this blue line represents trouble. This blue line represents where the market may stop, where it could bounce, where it may break. Doesn't it make sense to give up 3 ticks and at least have one of them at the bouncy point? That's a great management tool. Love your entry. How did that one turn out? Do you remember? I love it when you guys show me your entries. I love it more when you show me your exits. It didn't work. So can we go a little next level, Joe? Already a fight on the small chart. Another fight on the small chart. Another fight on the small chart. Do you see how the buyers are starting to tell you that they're getting tired of the sellers? And I'm not sure the large triggers broke this last divergence, the second divergence, which means technically this is 3 divergences in the same price range because the large triggers didn't get below it either. And it's the same idea as areas. The way the small and the large have to break, the small and the large have to break for this divergence. which means 3 divergences in the same price range. And what do we know that to be? Termination condition, which decreases the likelihood of success. Pretty cool, right? You're not going to see this in the moment, Joel. Not if you're new. But if you post in the room, I get to study it a little bit too, and I don't have the fear of losing. I don't have the adrenaline. I don't have any of that stuff you had in the heat of the moment. That's why annotation is so huge. That's why posting in the room is so huge. I love it. Jen, odds favorable, clear path. You entered on the right side of the triggers. Okay. Quick profits. Had order to sell at 58.15. It didn't fill. Got it to the tick, didn't fill. Gave up a little bit on its way down. No big deal. I think you're tricking yourself into believing this is safer than it is, Jen. Like confirmation bar, I love it. Establishes risk. But giving up 2 points, right? So why is the KISS plan target at $100? Because with all of these advantages, that's the one that's most likely to get hit. And that's when you protect yourself. And if you are protecting yourself up here, you're in the best part of the trade. That's okay. You're great. You got your mojo. Oh, same great top. Trend trade down with momentum. The anticipation. The market has to do what I want it to do. The triggers are strong. It has to go down, doesn't it? Triggers are strong. It had to go down there too. And it didn't. And you gave it a ton of risk because you decided the market had to do something. Does that make sense, Joel? Let's back up. You gave this trade a metric. Nope, that's not it. Hold on. This trade. It has to go down. Let me add an extra 2 points of risk on it because it has to go down. It has to get through that termination condition. Hold it. Because of the great top, this termination condition I'm not worried about. This 50-50 doesn't faze me. This termination condition couldn't care less. It has to go down here because look at the great top. I love your entry, but it's an entry directly into 2 termination conditions and a 50-50. How'd it work? Did it drop like a Led Zeppelin and break every one of those areas? I love the top. 3 divergences. I mean, the top is good. So let's go take a look real quick, Joel. And I hate to sound like I'm poo-pooing on your good time, and I don't mean to. 36 times, even with odds favorable momentum, it produced a loser. 6, you were able to make money. So one of the challenges and this is a pretty good example. So let's do this. Let's take this picture. And let's get our stop sign. Potential but didn't. Termination, 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 termination. Weak triggers out of termination. There a fib did print there. Oop, that one had the potential but didn't as well. Oop, that one didn't break. Oop, that pullback didn't go. Shoot, dang. That's a lot of times. Rule number 2 kept you out of a loser. That potential made it. Maybe a little momentum trade there. That potential, if it didn't stop you out, might have produced a winner. So remember that we're playing not the one time, whoops, that trading into 2 termination conditions and a 50-50 breaks. Remember, these have to be managed because even the perfect ones. So I'm obligated to throw that out there a little bit. And then at this second one, why would it stop in the middle of everything? Might as well take that to a fib. Good stuff, Joel. You are so in the refinement phase right now. You're in that stage where you're putting it all together. I love that coming from a strong top. I always love it. Potential to break. Absolutely beautiful. Awesome entry. Stop makes sense. Targets make sense. How did that one turn out? You're going to have to start showing me the finishes on some of these. Good stuff, man. I hope that one won for you. And that is so close to a clear path already, too. Nicely done, Joel. That's a good one. I think your entries are pretty solid, to be honest with you. Practice them all on sim. Figure out which one suits your needs. All right, so Gary, you had strong triggers up. You had the potential to break. You had a beautiful pullback. And you got out at trouble? I mean, my goodness, nice job, Gary. Odds favorable, didn't reach the area. Pull back to support inside of triggers, and you take it right up to trouble. I mean, my goodness. I'm stealing that one. You don't get to keep that one. That one's mine now. I want people to look at that because that's a great look. And Gary, did you get my answer on the log me in? I saw that this morning. I couldn't remember if I replied to you or just posted it in there. You need software? Well, the log me in stuff only works if Jason sends you a code. So you have to talk to Jason first. Does that make sense? It won't just automatically connect you to him, or he would be swamped all day long. So don't, yeah, so get him, hold on. Come over here, or I'll give you the link. Go put in a ticket, and then he'll send you a message. And then what he'll do is he'll send you that 6-digit code that'll get you into log me in, and then he'll be able to take over and get you squared away. Whoops. I put the wrong one over there. There we go. Did you check your messages? All right, hold on. So what I'm going to do, yeah, don't ever let it go that far. Don't ever let it go that far. If you guys don't get a response from tech, and it's rare that you don't get a response from tech, let me know, and I'll just send a message over. We've got a chat group for everyone that works for Nexgen. And a lot of times, what happens is they send you the message, Gary, and maybe you get a request and don't see it or something. I'm not making excuses, but I know how thorough Jason is. Oh, so info at Nexgen isn't tech, Gary. Info goes to sales. So when you put in info, you get put into the leads. And if you're doing it on the weekend, you have to remember we do take days off. So if you put it in Friday afternoon when the day was done and then you had Saturday, Sunday, those 3 days don't really count. Yeah, Thursday, Friday, no worries. So the path for tech, if you need tech, is to go through tech support here. Info at Nexgen is designed for new users looking for demos or a little more information on the software. And sometimes it takes a couple days because our sales staff goes through it. And if you get 50 or 60 of them in, you might find yourself at the tail end. So yeah, let Jason, and I dropped it in the room over there. Drop that tech ticket in for me. And he'll be looking for you. He'll be looking for you in tech. Yeah, I don't want anyone to ever get frustrated because one of the things we pride ourselves on is the customer service that we provide. All right. Joel, clear path or 50-50? That's the one thing that I notice you don't put on your charts. You love to talk about where it's coming from and what your trigger looks are, but check this out. Smalls are below. I don't know why I keep doing that. Smalls are below. Come on now, Mark. There we go. Your large have not broken 1, 2, 3 areas. No worries. Better Dad, have a great one. So what you actually have here is you have a 50-50. And that's the potential to break. Not a clear path. Does it mean there's not a trade? Of course not. It means I have to manage assertively because it's not a clear path. And you've already had one indication that the buyers are starting to react right at that key area that's not broken. And you have another indication that the buyers are reacting at an area that's not broken. And you've got weak triggers hoping an area breaks. Did this market go up and catch that big old stop? So do you see how the chart read works, Joel? And it's pretty cool lesson here. And let me go back and do this. And I'm telling you, this works for me, guys. Everything that I throw at you may not work for you, but this works for me. So if I have momentum, then I look for a clear path, right? And a clear path is small and large through, always. It's not only the smalls through. So, but Joel, what you could have done here is said, okay, I have momentum, but I don't have a clear path. Does that make sense so far? I have momentum, but I don't have a clear path. So what does that mean? That means that I'm going to focus my attention on making sure that these two things are perfect. Because I'm already missing 33% of my advantages. So when we go to your chart, your small chart is going to be your tiebreaker when the large chart is missing an advantage. So divergence is a loss of momentum. But it's small chart, so we'll take out a third of it, right? Weak triggers is also a loss of momentum. We'll take out even more of that momentum here, right? So now all you're really working with is that entry area. And that's really not enough to feel like I want to risk money. Does that make sense, everybody in the room? I have a good look with the potential to break, but my small chart is showing me the change that I can't see over here. And I'm not surprised that that hit the stop. You're welcome, Joel. And Joel, 84 was the top of your triggers. 85 and a quarter, brother. You're throwing money away, smoking hopium. You're throwing cash away. Saying, I know that if it blows past here, it's not where I want to be, but I sure hope it goes. That's why I always talk about when you know what's good for the trade, when you know what you're up against, it'll completely change the way you look at your entries and your management. This is fun. Joel, if we ever bump into each other, I owe you a beer because you're throwing some awesome lessons into this room. Wayne, is that where you're at? I was wondering about you earlier. I was like, where's Wayne? Wayne is showing off right now. That looks beautiful. Looks windy. Cancun. Love me some Cancun. That water looks awesome. Hope you're having a good time. Tell Miss Trina we said hello. It's like 10:30 there. You should be drunk by now. What happened, Wayne? Great stuff. Great lessons. Great lessons. And there we go. Potential to break, and eventually it did. It did dance a little bit, but it did ultimately break. And then look at the reaction happening right off of the key area without triggers in. Good stuff. You guys are killing it today. That's the one everybody took. And then we get weakness. And this is a good example, guys. The large chart is showing you a slowdown with the trigger lines. Does everybody see that? Take care, Wayne. You guys have fun. The large chart is showing a loss of momentum. I want to make sure everybody sees that. Small chart says, yep, we're losing momentum. Small chart says, hey, guess what? Momentum, seriously, it's a fight. Third divergence, small chart's like, man, guys, change is coming. And look what the large chart's doing. It's pushing down. And this is what happens. You ready? You ready? Because even if you're not, this is what we're going to do. Some of you got in here and lost. And you're like, oh, I'll take that one. And it loses, and that's fine. It's a loser. And then you said, oh, no, I'll get back in with a confirmation. And you lose again. You're like, well, maybe it's the one-to-ones that'll hold. And you lose again. And guys, you could do that all the way down. Right? I mean, you could do that over and over. Once you're on the wrong side of those triggers, you don't know if, when, or where. And that's why the rules are so important. If you got in on the edge there, right, and lost it, it's 5 ticks, whatever, that's cool, no big deal. Don't keep dancing with your date if she doesn't want to dance with you. Good stuff. Joel, we saw it, right? No, we didn't. Will the fib hold? I don't know. Joel, you probably won't even get there, right? NASDAQ, termination, weak triggers, one-to-ones, 3 divergences. Hell, I don't know. I know how to find out, though. Will the fib hold? My sources say no, Joel. That's... Anytime you ask what's going to happen, you may as well go to the Magic 8 Ball. You'll never know what's going to happen, guys. Accept that. You'll never know what's going to happen. But you do know that without momentum, or areas inside of triggers, you don't have the advantages. You're not trading the pattern. And that's what we're looking for. Do I sound like a broken record yet? All right. So you created your ticket. Awesome. You are ticket 2412. So when he's done, Gary, with 2406, and he's done with 2409, he's going to get with you. Cool? Is there something I can help with, maybe? Because sometimes I can pull stuff off. You have software. You posted a picture of your software. Is it just a technical question? Do you need software on another computer? Are one of your indicators not printing correctly? Maybe I can help. A lot of times I can help with the simple stuff. And I certainly don't mind helping if I'm able. Whoops. All right, guys. I'm going to shut down.